Welcome you all. In this video, we are going to see about how to raise the capital by the company by way of issue of shares and its accounting treatment under the course Corporate Accounting. In this video, we are going to see about the definition of company and the kinds of company and what are the types of shares and what are the types of share capital and the accounting treatment for the issue of shares. Let's see definition of company. A company is an artificial person created by law having a distinctive name, a common seal, a common capital, employed of freely transferable shares, carrying limited liability and having a perpetual succession. Perpetual succession means the company has a lifetime even when the members have gone and went. It has a successful life even the members are went and gone. Let's see the kinds of companies. The companies have three types, that is a statutory company, registered companies and government companies. And the registered companies can again be classified into private companies and the public companies. Private company means the entire capital is owned by the private members, and public company means the entire capital is owned by the government. Let's see what is share. The capital of the company is divided into small parts of a fixed amount and each small part is called the shares. Example, if the capital of the company is rupees 1 lakh and it is divided into 10,000 units of rupees 10 each shall be called a share of the company. Kinds of shares. There are two kinds of shares which can be issued by the company for raising the capital from the public. That is the preference share capital and equity share capital. The preference share capital is nothing but these is also a kind of share capital which is raised by the company from the public, but only difference is the preference share capital or the shares owned by these shareholders are called as preference shareholders. They are getting preferential rights at the time of getting the capital when the company is going to wind up. And second type of the share capital share is equity shares. The equity share is nothing but it's a normal shares which can be issued by the company and raise the capital from the public. Let's see the types of share capital. First one is authorized capital. It is the maximum capital that the company can be raised from the public throughout the lifetime of the company. It is otherwise called as nominal capital or registered capital. Second type of capital is issued capital. It is a part of the authorized capital which can be issued by the company for subscription to the public. And next type of capital is subscribed capital. It is a part of the issued capital which is subscribed by the public. That is, which can be purchased by the public. Out of the issued capital, how much capital is purchased by the public. And next type of capital is called up capital. It is a part of the subscribed capital with regard to which the calls have been made. That is, if the share price issued by the company is rupees 10 means up to the date of balance sheet preparation, the company can make a call to the shareholders up to the first call money, that is up to 8 rupees can be called by the company to pay the amount to the shareholders means that is called as the called up capital. And next one is paid up capital. It is a part of the called up capital which can be paid by the shareholders. Right. Next one is mode of issue of shares. The shares can be issued by the company either at par or at premium or at a discount. Let's see what is the accounting treatment for the issue of shares when it is issued at par. At par means that is nothing but face value. If the share price is rupees 10 means the same rupees 10 is issued to the public and raised from the public. It is called as the shares are issued at par value. The accounting entries for the issue of shares when it is issued at par. For the application money received, bank account data to share application account. For the transfer of application money, the journal entry is share application account data to share capital account. For the application money rejected, that is, if the company has received the application money over and above the issue of shares, in that case, the company can refund the application money to the applicants, those who are paid in excess. That is, the applicants, those who are not yet get the allotment of shares with the company, their application money is refunded to the applicants. In such cases, the journal entry is share application account data to bank account. For the allotment money due, the journal entry is share allotment account data to share capital account. For the receipt of allotment money, the journal entry is bank account data to share allotment account. Then next journal entry is for the first call money due, share first call account data to share capital account. Then for the receipt of first call money, the journal entry is bank account data to share first call account. Then for the share second call due, the journal entry is share second and final call account data to share capital account. Then the entry for the receipt of the second and final call money is bank account data to share second and final call account. Then the issue of shares at discount. A company can issue shares at a price which is less than the face value of the shares is called as the shares issued at discount. For example, the face value of the shares is rupees 10 means the company can issue the shares at rupees 9 means then it is called as the shares are issued at discount. The journal entry for the issue of shares at discount is share allotment account data, discount on issue of shares account data to share capital account. The discount on issue of shares is a capital loss and will be shown on the asset side of the balance sheet till it is completely written off from the profit and loss account, and the discount allowed only at the time of allotment due. Next, the issue of shares at a premium. When a share is issued at a price which is above its face value is called as the shares are issued at premium. For example, if a share of rupees 10 is issued at rupees 11, then rupees 1 is the premium on the share. The journal entry for the issue of shares at premium is share allotment account data including the amount of premium to share capital account to share premium account. Share premium is a capital profit. It will be used to written off capital losses. It will be shown on the liability side of the balance sheet. Then what is pro rata allotment? It's nothing but over subscription. If the number of shares applied is more than the number of shares issued, then it is said to be pro rata allotment or the company's shares are oversubscribed. Example, application received is for 15,000 shares, but the company can issue only 10,000 shares. That means the company issued 10,000 shares, but the applications were received for 15,000 shares, means it is called as oversubscription. In such cases, the company can allot only 10,000 shares equal to the 10,000 shares issued by it. In that case, the directors may either totally reject 5,000 applications or they may be allot the share on pro rata basis, and hence it is known as pro rata allotment. Pro rata will arise only when the oversubscription is received. At that time, the company need not refund the excess application money received, but it can adjust the excess application money received on allotment money and call money due. The journal entry for the pro rata allotment is share application account data to share allotment account. The formula to calculate the pro rata allotment to a particular applicant is total share allotment divided by total shares applied and shares applied by a particular applicant. Thank you.